I am Arti and I'm going to explain financial model created by me on D1.5 Bookstore 101. So we can see Bhagavad Gita and Ikigai books are the products which Bookstore 101 deals with, and here is the purchase quantity, sales quantity, as well as purchase price, sales price. All this information can be seen here. Issues, shares and issue price, it has also been provided. Now we can also see that salesperson salary, electricity, rent, all these expenses has been shown here. Now term loan information has also been provided with the respective interest rate and the bank information from which bank it has been taken. Now next is what we can see that fixed asset has been purchased with their respective useful life information can be seen. All the loans has been repaid on the date of repayment. Dividend information can be seen here, as well as tax, which is 20% on the profit after tax. So what we have to do is we have to calculate the model for 24 months. In assumptions we have shown each and every information clearly, and in FAR also we have shown all the information related to fixed asset too, so that we can use it further. In fixed asset balances we can see that opening balance and purchase and disposals has been shown. Purchases in month 1 for self and month 4 AC has been purchased. All this information can be clearly seen, and its disposal can also be seen. Then in month 20 it has been disposed, AC has been disposed, and the effect can also be seen that it has become zero after the disposal. How we have calculated our closing balance? We have added opening balance with purchases and deducted disposal so that we can get the closing balance. Now depreciation, we have calculated our closing balance of depreciation by adding depreciation for the month with opening balance and deducted accumulated depreciation and disposal. Now we can see that depreciation for the month has been calculated by dividing the amount with the respective useful life. Calc 1, in Calc 1 we can see the purchase quantity and sales quantity of the respective product. Sales and cost has been calculated. In sales has been calculated by multiplying sales quantity with sales price. Cost of goods has been calculated by multiplying sales quantity with cost. Other cost information can be seen from the reference with the assumption sheet. Rent, electricity, salary. Total cost has been calculated by adding cost of goods sold with other costs, and depreciation has been shown with the reference to the depreciation sheet which we have calculated before, because of which profit before interest can be calculated by deducting sales with the total cost and depreciation. Now interest expenses can be seen with the reference to the loan and interest which we have calculated. So let's see what is loan and interest. As we all know that the loan is a sum of money that one or more individual or companies borrow from bank or other financial institution so as to financially manage planned or unplanned events. And as well as capital. What is capital? Capital is typically cash or liquid asset being held or obtained from expenditure. So let's calculate our loan and interest. So in loan and interest sheet we have shown all the information related to loans. As we can see the opening balance, so closing balance of the month 1 is the opening balance of the month 2. We all know that loan taken is shown with the respective months. In month 1 as from SBI loan has been taken, and in month 9 IDBI loan has been taken. So all this information can be seen clearly. Disposal, a loan repaid can also be seen that in month 16 loan has been repaid, which were the loan which has been taken from SBI. We have calculated the closing balance of each and every loans. How we have calculated? By adding opening with the loan taken and deducting loan repaid. So we have calculated our closing balance in that way, and we can see the effect also. Now what we can see that interest paid, we have calculated our interest paid also. How we have calculated? By multiplying closing balance with the respective interest rate and divided it by 12. Respective interest rate has been given the reference with the assumption sheet. And next is what? Stock. So we have shown all the changes in the stock by deducting sales with the purchases, and calculated our closing stock by adding opening stock with change in stock. Now closing stock has been calculated in rupees by multiplying closing stock quantity with the cost. Now next we have used all the informations in the sales and cost, like in loans and interest. As I have shown you that interest paid has been calculated, so we have shown it in sales and cost, all these interest expenses. by referencing that. And then after that we have got the profit after interest. How we have calculated it? By deducting profit before interest with interest expenses. Now tax expenses has been calculated by multiplying with tax interest, and reference has been given to the assumption sheet, in which we have clearly mentioned all the information. So we have multiplied with profit after interest, the tax rate. Now after that we have calculated profit after tax. We were able to calculate it by deducting profit after interest with tax expenses. Now next we can see purchases. All the information can be seen here. Purchase in rupees has been calculated by multiplying purchase price with the purchase quantity, and payment made for purchases were every 3 months payment has been made. So all this information can be seen here clearly. Now after that, outstanding payment for purchases can be calculated by deducting payment made for purchase with purchases. So it has been used in the balances. So we will see it further. In collection sheet we have calculated the collection information. Sales to different parties has been shown here with the sales and cost reference, and collections after 1 month collections have been done. So all this information can be seen. Cash to be collected has been calculated by deducting collections with sales to different parties. Now we can see the capital where we have shown issue price and number of shares with the respective month. Sales share capital issued has been calculated. How it has been calculated? We have multiplied it with issue price with number of shares, and the dividend per shares has been shown with the respective month by referencing the assumption sheet. And dividend in rupees has been calculated. How it has been calculated? By multiplying dividend per share with the closing number of shares. So we are here with the dividend in rupees. Now next, loan and interest. I have told you that how we have calculated it, and we are here with the cash details. So what about cash details? We have put the reference of the respective sheet, that collection from customer. We have provided the reference with the collections which we have calculated. Now cash from loans. So how much cash has been obtained from the loans, which we have calculated in loans and interest column. Cash received from equity share capital we have calculated in capital. So all this has been calculated previously only, so we just have to reference it, and we got our total inflow. And after that, total cash outflow has been calculated. Payment for fixed asset purchase references has been made from the fixed asset balances. Payment for purchases can be seen from the purchase sheet, which we have calculated by deducting. You can see here. Now next, what it is? Payment for other cost, which we have reference to the sales and cost, loan repaid, interest paid, and dividend paid. All these three has been provided from the loan interest sheet and capital. Tax paid from the sales and cost sheet. So we have calculated our total cash outflow by this way. And then net cash for the month can be calculated by deducting cash outflow with the inflow. So we have deducted it. So we got the net cash for the month, and then we have calculated our closing cash in hand. Now next, we have used that closing cash in hand here in cash in hand in the assets, under the asset head. Now we can see fixed asset has been calculated by deducting fixed asset balances, closing balance of fixed asset by deducting it with closing balance of depreciation. So we are here with the fixed asset. Stock has been references with, we has given the reference with stock. Cash to be collected we have calculated in collections, so we have referenced it. Now we got the total asset. In that way, liabilities has also been referenced with the purchases, payment outstanding for purchases, term loan with the interest and loan and interest B25. You can see here term loans B25. This is the closing balance. So we have provided the reference so that we can get our total liabilities. Now in that way we have we got the difference amount total, deducting total asset with total liability. And here are the references with equity share capital and accumulated profit, in which dividend paid for the month has been shown. How we have calculated our accumulated profit? By adding opening profit with the profit for the month and deducted dividend paid in the month. So in that way we have calculated our total equity and accumulated profit by adding equity and accumulated profit, and difference is 0. So we have reached here. So that it proves that our calculation is right, as we have the difference in 0. So we can see by we can come out with the information of this bookstore, that how it is being processed, what is the profit. Each and every information can be known clearly in this sheet from the purchase sheet collections capital. So thank you.